Good afternoon. Welcome to Chicago Future of Finance. I'm Oliver Renick. We're live from SIBO in downtown Chicago. And we have a pretty interesting session underway, a little Wednesday surprise, a nice little bounce as stocks are looking pretty good. Bitcoin's bouncing back, crypto's looking pretty solid. As I mentioned yesterday, this show is going to be shifting more towards the trading side from here to the end of the year. Chicago is the future of finance, not just because of all the options, infrastructure, and the trading that's being built right here, but also because of the big advisor money center that it's become. But for the next couple of days, the market's in a really interesting spot. So this is a big time trading focus as well as event contracts, things going on. The political side, the shutdown keeps running on. You've got Trump tariffs being gauged by the Supreme Court. And of course, in the background of all that, the stuff that probably matters the most, which is earnings. That's where obviously AMD and the semiconductors are having a pretty good day. I think that's a really important part of today's session. You got semiconductors up 3% right now, a chart that looks pretty good overall. All things considered, I think that it could have been worse. The fact that we got a bounce after high expectations. Yesterday we talked, there was quite a bit of positioning to the downside, and AMD, there was some put speculation. So the fact that actually it's working out pretty good today for semiconductors is very, very important. I think Bitcoin too is important as well. The fact that you've got crypto firming up, that's been the weakest link of the risk asset puzzle. So to see Bitcoin up about 3% right now is pretty good. I think also thinking about Ethereum too, the fact that it's up 8% after getting just crushed from near 5,000. ETH bouncing back is important as well. So those charts that have gotten really damaged are firming up a little bit. That's a positive thing. Look at the Russell, bouncing pretty big. We're going to talk some small caps with Danny Kirsch of Piper Sandler joining us today, in addition to Brent Kochuba of SpotGamma and Charles Moon, Prosper Trading. We're going to take a look at some of the real key things on the event side as well, because there is a good bit of uncertainty, I think, surrounding some of the political components right now. But not that I think they're the big movers necessarily, but the fact that there are some potential tariff pushback coming from the Supreme Court. That's possibly something interesting to think about. If you look at Kalshi, the odds that the Supreme Court is going to rule in favor of Trump, they went way down. So I do think that that's notable. There we go. That drops substantially, the idea that this is going to be a positive ruling for Trump. So the fact that that's coming off maybe also helps remove a little bit of uncertainty. If you think the market hates tariffs, the fact that that came down perhaps does support the notion that there could be some tariff relief. If the Supreme Court says, no, this doesn't make sense, this doesn't work, and they rule against him, then that potentially could be a bullish thing. I'm not sure I want to read too much into that, but it is a possibility that you could think about that as well. So that's kind of one thing that you want to keep in mind. The other thing is that on the political side, obviously I'm still in Kalshi here. New York City mayoral election, Zoran Mamdani is taking it. And that's also perhaps why Chicago's the future of finance. I won't inject too much personal opinion there. The charts for today, I think, that are the most important really are the semiconductors. That to me is just crucial again. I've talked about how the semiconductor chart does look better than the overall S&P 500, and I think that is pretty evident now when you're looking at what was basically like an ascending triangle, and we were able then to break out. So here's the chart for the SMH semis on Trader Oasis here. That's a pretty nice move today. Nice big green candle. Zooming in, this area on SMH, 346 down, basically to 330 was support. So we broke out, had this great rip, and then came back down. This is a nice big green candle for the SMH today. I think that you are pretty darn happy with that. If you go to AMD as well, the fact that AMD is looking pretty good at 257 right now, that's important as well. Look at the IBIT for the Bitcoin trade. You can see that for IBIT, $60 really needs to hold. That needs to be support, or else you're going to have some major breakdown. That's my take basically on the charts for the most part. By the way, another little promo as we're going out live on Benzinga next week, 5 days from today. We got a great panel that's coming to you from New York. I'm going to be joining Matt Cashman, Anthony Rousseau, as well as our guy Brent from SpotGamma. We'll be in New York, and we're going to talk about some of the themes that Chicago Future of Finance has obviously been about, which is the trading boom, the options infrastructure being built, all of it really that has so much to do. There's no coincidence that this is a very Chicago-centric panel. Even though Brent's in the New York greater city area right now, of course, Chicago roots. Let's go ahead and bring him in. I know he's standing by here, so let me grab him on Zoom, and we'll get into SpotGamma. As I think overall the market looks pretty decent. Brent, thinking about the overall kind of rally mode that we've been in, bouncing back. Yesterday, your point was that, it looked like it was more kind of a systematic moment of, reset. That was kind of my point too, with the crypto stuff coming off so hard, is, maybe we just needed to wipe a little froth off the top. And I think to some extent that's, kind of what's happened here. Brent, tell me what you're thinking.
Yeah, those are good points, Oliver. We wrote this morning how if you compare this sell-off to October 10th, and the reason that there's some similarity there is that correlation levels, the extreme bid to calls was very similar into October 10th as it was last week, right? People were very piled into calls. And in October 10th, we had the VIX first bond go to nearly 30, while the S&P dropped only about 2 to 3%. In this case, what we started to see is those call positions started to roll off after the events last week, Mag 7 earnings, the Trump Z meeting, the FOMC, right? That started to reduce the volatility, the upside volatility a little bit. And so what we're seeing now is a very subdued vol reaction to a similar drawdown, right? About 2 to 3% from the highs. The other thing that's fascinating me about this is that last week, we were talking about how call skews were in the 95th percentile, and people were just chucking rocks at us left and right over pointing out that stat. And then yesterday, everybody is scorched earth. The world is ending. The whole system is about to collapse, right? And then what do you see today? Like, there's a bunch of ball sellers out there. Fixed strike vol is getting crushed. The VIX is, slumping back down here. Does this mean we're in the all clear? Not yet. We're still surrounded by a lot of negative gamma. When you look at something past 0 DTE, I still don't think that the S&P is stable until we get above 6,900, at least according to the positions that we're seeing. And so, AMD earnings came out last night. They seemed fine. There's some questions about some margin stuff. As you mentioned before, Bitcoin's getting a little bit of a bounce. It got, just clubbed. But the big signal and the big thing that bullish should be happy about here is, again, volatility. When you see that fixed strike vol come down, 2-3 vol points, that's pretty significant. And, that momentum trade just starts to pick back up. And as we talked about yesterday, volatility is such an asset class, right? There's so much alpha generated now by selling vol anytime there's a little spike. And so, there's a bunch of, guys and gals today who took the opportunity to sell that vol, and right now they're looking pretty good, even though the S&P has only bounced about 50 bips to 1% today. So just re-summarizing that, we've burned off the really rich calls from last week. We were clearly over our skis. The market contracted. It mean reverted here a bit. Vol did not react all that much into the selling yesterday. Today, we're seeing that vol contract, and we're getting a little bit of a lift again in the S&P 500. I don't think that this is a long-term stable situation, again, until we get over that 6,900 level. But as you can see there, the S&P is down fairly low in that compass, which tells you that the IV rank into this selling is not all that elevated. And the other thing is, we're not in an extreme put reading, but if you click that little historical trail there at the top there, Oliver, you can see where we were last week. Hit that and go 10 days.
Okay.
So this tells you the path where we were the last 10 days. That shows you right there that extremely rich call valuations that I was talking about just 10 days ago, right? Everybody was bowled up last week into the FOMC, the Trump Z meetings, and the Mag 7 earnings. And those events were okay, right? They were fine. Earnings were fine. Trump Z meeting, who the heck knows what came out of that? An FOMC, I don't know, we'll see. right? There was a short-term bond reaction, but now it seems like odds are tilting back in favor of a cut in December. So overall, we just burned off that very overbought condition. And right now, you kind of got to give the benefit of the doubt to the bulls because that's been the market we've been in for what, 4 years now or 5 years since the 1920s. I guess you just buy every dip, right?
Yeah,
Um,
pretty
it
much.
works
Pretty
out on a
much.
long enough time horizon.
Yeah, if you got a long enough time horizon, of course. So, Brent, I mean, look, I think that to your point also, just looking at how this changed pretty quickly, was that
Yeah.
the opportunity to buy this dip was pretty apparent yesterday. It was pretty clear. The question is, all right, how do we then kind of play going forward? How do we know if it's back up and away? My kind of like shorthand is basically to watch semiconductors from the sector side because I believe that's the most important narrative, which is still AI, which is earnings. Obviously, there's some
Yep.
other kind of macro stuff that's a little bit uncomfortable. The shutdown like is never ending.
Yeah.
You've got kind of some edge politics sort of on the end of the spectrum taking over in New York. That's one thing. I, again, don't think those are big deals necessarily. I think the market mostly cares about earnings. But putting that kind of narrative stuff aside for the moment, technically, volatility wise, what would you look at to say, all right, we are back. This is not just a day dip buying, this is more trend resumption.
The volatility decline is one big step there, right? And it seems like maybe, and I'm not a political expert, so I'm straying way off my course here,
Yeah.
but it seems like all of a sudden, the Democrats are looking for discussions now that the elections are over. So would politicians use something like that as a political ploy, for their own gain? Like, of course, like, so maybe there's something there, and that's why vol's contracting a bit. Maybe vol's contracting a little bit also because of the SCOTUS and some of the tariff news that was coming out earlier this morning that seemed to help clear the path just a little bit as well. So, whatever the reason or reasons are, vol is absolutely contracting today, no doubt about it. But as we talked about yesterday, fixed strike vol in the S&P term structure is really inflected for the NVIDIA earnings that are coming up next week. They're coming up on the 19th, so it's about 2 weeks from now. That's really going to be the big event. And I think in that event, it's going to be, unless NVIDIA just totally drops the ball and surprises everyone to the downside, then you also have to remember that there's that end of year seasonality, which always catches people off guard. I could think of so many years over the last 4 or 5 years where we've had a big rally into the end of the year and people are going, what is going on? I just don't understand it. And somehow we end up rallying right into that December options expiration period, right? Mid to late December. So I think that you, again, just have to give benefit of the doubt based on the fact that vol is contracting. And if NVIDIA is meat to beat in earnings, then, I think to your point, the whole semis catch a bid. As you can see on your screen there, they're still fairly bid. Why are they still bid, even though
Yeah,
there
it's
was a
interesting.
contraction there in SMH? People buy the dip. That's what they do. There's a dip. You look at names that have sold off, a Palantir or Hims, names like that. People buy calls betting on mean reversions. And that seems to be a very, consistent behavior in this market. And so, there's no real strong put buying in any of these asset classes at the moment.
Yeah, it's interesting the way all of these values kind of shift over to the right. The closer that
Yeah.
you get to the actual specific names and the sectors in the SMH, then further you get to the risk reversal, higher risk reversal rank, higher IV rank with NVIDIA still with the earnings ahead, that highest IV. Yesterday we
Yeah.
looked at your volatility curve looking out at different expirations, and there was a pretty big kink. Was it in S&P or VIX, was it, Brent, we were looking
Yeah,
at
we
to
were
see
looking
the
at
NVIDIA
the
date?
we were looking at the SPX term structure. So if you go to the vol
Right.
dashboard there on the left, you can pull that up. There's some economic data next week. There's a cadre of data that's coming out, and fixed strike. The forward implied vol is so hit that little 3-line icon there, top right,
Yep.
and you can add that forward implied vol in. And that gives you a sense of, if you look
There it
at
is. There's
what the
NVIDIA,
implied
right?
vols are between exactly. So the 19th, a little bit more to the left there, the bump that's December. So there's
Oh,
another
I
big
see.
bump
Yeah,
to the
yeah, yeah.
left.
Here you go. There it is.
There
Closer.
you go,
Yeah.
right
Okay. Yeah,
there.
there we
Yep.
go.
So that is incorporating the NVIDIA earnings. You also note that to the left, there's a smaller node that's higher. But the fact that the forward implied vol is higher than S&P term structure tells us that traders are expecting higher volatility into those events. That tells us that the event vol around these data points matters more to the market. And so, you could say, well, today is Wednesday. We got Thursday, Friday, and then we got a weekend. So if you're a zero DTE trader or short dated trader, maybe you have a short term all clear. You can sell some vol that picked up a little bit, and then we'll get some economic data updates next week. That'll clear up the December rate cut issue, and then obviously all eyes are on NVIDIA into that earnings report. And another point on that, if you look at the low of the market into the 1010, when the VIX hit nearly 30, the market rally started immediately on October expiration because we cleared out all that puts, all those big puts. We cleared out a bunch of VIX calls there, right? And that really cleared up the market and allowed it to rally. So if there is some weakness into this NVIDIA earnings, and NVIDIA earnings are good, and we start to have a big expiration with VIX expiration right around that same time, that is also a great time for the market to kind of spark a rally off of that too. So I think what I favor here is chop over the next, week. A little bit upside, a little bit downside. We just kind of stay range bound, and then everything kind of gets cleared up over the next 1 to 2 weeks.
Almost sounds like what the plebes might call a Santa Claus rally. Actually, no, I shouldn't make fun of that concept. It's pretty real, that kind of end of year thing. Strength, if all the kind of items align in that mid to late November plus early December. To your point, there is a pretty big coagulation of events there, whether it's some of the political stuff, if it's earnings. I think that's where AMD too. Today's move is pretty important, and the SMH, as I mentioned, the bounce. I want to go back here to see where AMD moved to after its report. I guess volatility is still fairly elevated, or does that kind of take a day to settle, Brent? What should we make of that?
Yeah, that vol point is from last night's close. So as this updates, you're going to see that AMD move a little more to the bottom left. Stock's up 3% right now. The volatility is very high. That's an unusually high vol point into earnings for that stock. And so there was a nice vol crush there. They keep the narrative intact, right? Earnings, they guided higher, they beat. I think that considering how weak the market was yesterday, the opportunity for bears to take that name to the woodshed was there, and they didn't, and the stock's up nicely now. And we're also seeing kind of call flows revert. If you remember yesterday, a lot of what the selling was this kind of systematic flow that was coming into the market. And that systematic flow, is here today and kind of gone tomorrow a lot of times. And what we're seeing today is a little bit of a reversal of that, right? We had a negative hero reading on the equity side of negative 2 billion. Today we see positive, nearly 1 billion. So there's a lot of noise out there in some of these short-dated flows. But today, the short-dated flows are pointed higher. And again, I think the more material signal is, number one, to your point, semis are still bid. That's critical for this market. And then number two, those balls are really getting sold off, not just in the short term, but just over the next 1 to 2 weeks, we see that vol contraction, which I think is just, again, such a healthy sign for bulls. And watching that volatility space is just, I think, really not respected enough by people outside of the Chicago sphere of influence.
There you go. Amen. I'm looking at some of the, positioning around further up. It seems like there's quite a bit going on in the 7,000 strike for S&P. Am I reading that right, Brent? Or is there
100%? Yeah. In that area, you start talking about the JP. Yeah, you start talking about the JP Morgan call into the end of the year, so that's always a noticeable target. But what catches my eye there, Oliver, is the negative gamma. So that purple line that goes from left to right on your chart, it's negative there, and it goes negative at higher strikes, which infers that if the market starts to catch a little bit of a bid here, that there could be a little bit of a chase to the upside. Yeah, that's what the implication is. And just imagine, if we get a resolution to the shutdown right now, or just some positive shot in the arm that people aren't really watching, I think that chase could manifest pretty quickly here. It's been a market that's had so many chases over the last 6 months. And so, I just think that what that represents is there are two tails to this market right now. There is always that left tail that's lurking because of credit market issues or tariffs or whatever it may be, but you got to respect that right tail. It has reared its head several times this year, and particularly in the end of the year, we all know, if you're behind as a fund manager into year end, you gotta start to chase, right? You can't afford to miss a final rally,
Yeah, facts.
and the opportunities are there, right, for that market spike to happen.
Total gamma negative 12 billion at
Yeah, and
70.55 strike. So if we
And I
get
would
through there,
expect that
then
number to fill in, yeah. As we rally, as you know, with the systematic call selling that is so pervasive in these ETFs and strategies like the JP Morgan Hedge Equity Fund, or QILD is another big ETF. Generally, what happens is the market rallies. You'll see some systematic call selling start to fill in, particularly in those kind of like 2 week to 1 month 25 delta put areas. Those will oftentimes start to get sold. So I think that negative gamma would fill in. I don't think we would rally that hard and fast and still see that much negative gamma. But the overall picture of negative gamma to the upside is still one to take note of.
okay. Hey, Brent, real quick, because some of this stuff is, I know you know Danny Kirsch, a Piper. He's up next. He's
I
got some
do.
of the kind of sector thoughts as well. He really wanted to chat with you. We're going to get that 3 box going. I'm taking it one step at a time producing this. But, Brent, before we go, stock specific wise, I know there's a function on here I like. There it is. Okay, I knew it was in here somewhere. Volumes for total options. For total gamma notional, it looks like for other than Nvidia and Tesla, it's mostly concentrated in some of the well, I guess look, the top daily
Yeah, hit the hit
movers. You got
the
Rivian,
hit the drop
Pinterest
down
in
there
there.
on the bottom right there, Oliver, if you don't mind.
Which
The
one?
little the green
Oh,
button there, the
see
drop
more?
down. Yeah, there you go.
Yeah, there you go.
So
Okay.
anything that has over a
Palantir.
million
That's what I was looking
contracts,
for.
yeah, anything that has over a million contracts traded on the day for single stock, not talking Nvidia and Tesla, any other name, that's big, right? So AMD, very big, big activity today. At IBIT yesterday, I heard you mention IBIT before. They put up something like 2 million contracts yesterday. Massive,
Okay.
massive day in IBIT. Kind of gives you the feeling of a washout, and a lot of that was in calls as well. So Palantir, catching that bid today, nearly a million contracts is really big. AMD obviously quite big. So, the overall picture here is, you can see those names. Those are the big retail names, right? Those kind of chasey names,
Yeah.
and they certainly seem to have a lot of the activity in them. And again, yesterday the big high flyer was IBIT, and unusual call volume there in particular, which is really particularly caught my eye, I should say.
Nice. Yeah, I bit 800,000. Top ranked right behind Palantir for total options. Rivian and Pinterest with some action on the dailies. Brent, great stuff. All right, appreciate you very much, sir. Thank you, Mr. Kochuba, SpotGamma. And we're going to continue some of this conversation, I think, with Danny Kirsch. Coming back in a moment here. We'll take a short little break. Going to run the promo. If it's your first time watching, we'll be RB. There are 2 things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. SIBO is on a 5-year growth streak making billions. And its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Renick, from SIBO, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago.
Yeah.
All right, welcome back to Chicago Future of Finance. I'm Oliver Renick. I got Mr. Danny Kirsch standing by as the head of options at Piper Sandler. And I know he's got some thoughts on SMH, XRT, I think a little bit of overlap to some degree, some of the stuff we just hit with Brent there. Danny, good to see you again. Long time no chat. What's up, man?
Hey, how are you? Thanks for having me.
Absolutely. We got a nice little bounce today. Some of the things Brent was talking about fundamentally there, we were mentioning some of the risks, some of the coagulation of events kind of on the horizon here, whether it's earnings or politics or elections. The other one he mentioned is the credit kind of crunch that's been happening right as some of the private market is really trying to like push this stuff onto people. I thought maybe that might be an interesting place to start. Is there any reason to think we've got like major cracks forming over the last week of this kind of softness that appeared in the market?
Yeah, I mean, I think you're starting to see a little bit here and there. I don't know if you noticed, but Upstart earnings yesterday weren't great. They missed a little bit, and that's sort of the tip of the spear as far as maybe not the best lending practices. No, I'd say not necessarily not lending practices. Just like they're dealing with riskier consumers. So, what we've started to see a little bit more of on our desk is downside buying in some of the consumer finance names. Like these are names like ALLY. They do a lot of auto lending. We're already seeing non-prime auto loan delinquency rates are sitting at all-time highs. Now, mind you, most auto lending is prime. It's not subprime, but the subprime piece is sort of falling apart, and that can have some trickle-down impact into a name like ALLY that, again, it had good earnings, but there could be some risk there. A name like Carvana, we've been seeing put buying. That stock's up 50% year to date. It's over $300. Mind you, this was a $3 stock a few years ago, but a $300 stock before that.
Yeah, it took a little hit from 400, right? I mean, that's
yeah.
Hey, but how many people thought this was supposed to go to zero, right?
Yeah, exactly. And I think so. It's like what we started to see is a little bit of like into year end, some just squaring away some positions. So downside in some of these higher flyer consumer finance names that could be at risk if you start to see any sort of consumer softness. And near term there might be, because you also have the Fed is sort of backing off, and you've heard Fed presidents saying like we're not necessarily going to cut rates again in December. You have the government shutdown, who knows when that'll end. And then beyond that, you have like this large increase in Russell names that are we call zombies, meaning that their free cash flow has been less than their interest payments the last 3 years. So it's just like there's like these. It is like this. I agree with the people talking about K-shaped economies. That's what's happening here. So if you can find downside in some of the weaker parts of the market or places levered to the weaker parts of the market, these consumer finance names pop out. You might have some near-term underperformance in those riskier parts, and then, I don't really think this cascades into anything much bigger. So I'd rather pick my spots.
Okay.
But like a Russell, Russell's rallying today with rates selling off. Like that shouldn't be happening. The only reason that's happening is because you're getting some sort of squeeze today.
That's kind of an interesting point. I was also thinking about bonds too, as I think it was Jeff DeGraff at Renaissance Macro, one of the best macro shops for sure, is the a caveat before what I'm about to say, which is that I really disagreed with his take, which was that you basically want to root for 10-year yield under 4%. His point a couple weeks back was that that's a good thing. And I kind of disagree with that, not because it's like, I think it's a bad thing necessarily. Like cuts, okay, are fine. Supporting the economy, having a Fed that people know has their back is all right. But when you really look at bonds over the long term, I mean, they've been range bound for a couple of years for the most part. Looking at TLT, it's been pretty much just going back and forth between like 92, a range between 100 and kind of 86, with that sort of 92, 93 in the middle, if you will. So my kind of view is you don't really want bonds too far in either direction. And to some extent, I feel a little bit validated because in the bounce back today, bonds are selling off. Now, I don't know if you want to root for bonds to keep selling. Like, I don't know if you want them to, yields to spike necessarily. Yields were going down for months and the market loved it. But I do feel like when bonds get to either end of the extreme, which is kind of like below 4% or maybe creeping up to 5, then that's kind of what you don't want. So my kind of view is you don't really want 10 years under 4%. Am I wrong? What do you think?
No, I would tend to. I think it's to your point. It's the volatility. It's the volatility of bonds that matters more than the absolute level. Obviously, above 5, that's a problem. If it's below 4 because of a risk off, like panic, that's not great either. I think to me, it's like the worst case scenario is what we saw like around Liberation Day, where you bonds selling off in equities. That's clearly not what's happening today. You're having bonds sell off, equities acting totally fine. So again, between 4 and 4.5, like you're fine as long as volatility is low in between those ranges, which it necessarily will be. So that to me is like how I think people think about taking risk. Is it's where's your volatility? Rates haven't been volatile. I don't think they'll be volatile. To your point, they've just been boring. It's been a boring space. It's been a good place to sell strangles.
Yeah. Tell me about the trades then. Okay, strangles. There we start to talk about it. Tell me about the structure of trades that makes sense to you, Danny. If you're thinking
So
about broad market first, I
so
guess.
near term, like some of the like we always think about what catalysts are coming. And unfortunately, because the government shut down, you lose a lot of catalysts. You don't get payrolls. We got that one CPI. It's unclear if we'll get another one. But what we are getting is the Supreme Court hearing on the IEEPA tariff, I guess, like the proclamations that Trump had and whether or not they'll be deemed legal. Polymarket saying they're going to be illegal. When we do get a decision, it's unclear if any of these companies will get refunds, but we'd expect some sort of near-term bounce in names negatively impacted by tariffs. So what we're seeing on our desk is upside buying in like an XRT.
Okay.
XRT has been ugly chart. Not as bad as like restaurant stocks, but it just hasn't done anything. It's not like if you look at like tech or S&P or even like industrials, like just XRT has just been
It's
kind
gone
of
about,
like
what, it dropped about 10% off the highs, a
yeah,
little
and
bit more, 11,
it's
12%.
flat since July, but it's also flat since December of last year. You know, you compare that to what SPY and Qs and basically and semis have done. It's just really been blah. I think people are short there. I think it's a funding short. So if you do get something where they say these tariffs are illegal and these companies are getting refunds, you're going to get a huge snapback rally. So we've been buying December calls and November calls. And the other thing is seasonally, November is just like an incredible time to be long. We looked, and over the last 10 years, S&P's been up 9 of the last 10 Novembers. XHB, which is housing related stocks, 10 of the last 10. Looking at XRT, 7 of the last 10, but up on average 6.6% in November. November is just historically a very seasonally strong month. I think part of that is holidays tend to be bullish. I know that sounds idiotic, but the fact that you have what we call delta decay, where puts deltas shrink and people who are short those puts have to cover some of their stock they're short against, which causes this nice rally. That's why July also tends to be a bullish month. I don't think it's a coincidence that both of those have holidays, so lighter volumes, this delta decay dynamic. Anyway, good time to be long. We like XRT, November, December calls to play for any sort of near-term snapback rally in retail names that everyone hates.
All right. What kind of strikes you thinking? How much of the sauce you want to give me here? We're looking at it trading at 81.7 right now.
Yeah, I'm looking. Let me see where these are trading. But I was thinking the Nov 85 calls are.
Okay.
Nov 85
Right, so
calls
that's
should be like
basically
95
4
cents.
sessions ago.
Yeah,
Get back
yeah,
to where
90,
it was last week.
Yeah, 95 cents, and then if you get to 90, you sell them at $5 or more than that. That'd be the dream scenario. You can go out to December, you'll get Christmas shopping. Those calls are, instead of paying 90 for the Nov 85s, you pay $1.75 for the DC 85s, but you'll get Christmas and you'll get all like the rest of earnings.
There you go. Well, Brent and I were talking
I think
about
I think there's a
Santa
Fed.
Claus
I think
rally.
there's a Fed in there too.
Yeah. I mean, hey, the ticket prices for travel again are pretty audacious. So it seems like if that translates into shopping, retail should be all right. I know in the IWM you were talking about the zombies, KRE as well, a subset which pulled back. But I want to come back to revisit that real fast on the small caps. Danny, take me through the approach there because it's a pretty interesting kind of a chop that we've had in the small caps. We've seen worse. They're hanging in there okay right now. I think looking at the IWM, basically range bound for a month after it made that high.
So I think IWM, you mentioned rates earlier. I actually think IWM can't go up with rates not going lower. Like IWM needs lower rates because there's just over-levered companies that don't have access to the type of funding that the large cap stocks do. And like the big beautiful bill greatly benefits large cap tech. Hence, you're seeing this massive data center build out because they can fully expense all their earnings. Like that's not the case for these smaller cap companies. Like it's just they're in a much tougher spot. So for my purposes, like I'm like, just to be fair, like I'm generally bearish on Russell unless you like I like playing it for trades. Okay. But this is where we go for hedging. I mean, this is where we look for puts. Typically, when rates go up, this should be selling off. I think today is a total short squeeze. That's why it's rallying. There's nothing fundamentally got better today. If you look at the biggest movers, it's like a bunch of super small cap tech companies you've never heard of, or maybe you have heard of because you spent time on Reddit. So I went we're pitching actually downside as like a near-term hedge, with the thought being that if rates keep backing up, Russell will underperform. I just don't think rates between 4 and 4.5% impact the S&P or Qs at all. I'd just rather be long Qs here or S&P, because I don't see a massive 10-year bond rally into year end.
So maybe
I think that's what you need.
Maybe the move is then you buy upside on SMH, or
An XRT, like XRT is like not the,
as you
it's a little
mentioned.
junkier stocks. You buy
And then
some
you hedge it
downside
with downside on Russell. So then do you just
or you can
make
sell
your
some Russell call spreads if you want to fund it. If you want to collect premium and spend premium. I wouldn't be naked short Russell calls, because this thing could go up 10% on a light CPI. Which who knows if we'll ever get another one. I mean, we're going to get a big data dump whenever they open the government again.
That makes sense. And you're saying you kind of do it by maybe a different structure for the trade, not necessarily just size in terms of like hedging. Like if I do want to be, my core position is that long SMH or that long XRT, how does the short IWM fit into it? Like percent, like volume size wise? You just say maybe just sell upside as a way to get that kind of more bearish tilt into the small caps.
So let's say we do this in NOVE, right? Let's say we buy the NOVE 85 calls in XRT. Those are about $1, okay? I would sell the IWM NOVE 250. You could sell the NOVE 250, 253 call spread at $1. Okay? The stock's 245. So your risk is if IWM outperforms, you'd lose $3 on the call spread. Obviously, you collected $1 in. You're spending $1 on their XRT, okay? So your max risk is $3 on this trade. Does that make sense?
Okay, yeah.
You're selling a $3 wide call spread at $1. You're buying a call for $1. The ideal scenario is XRT outperforms. Now, there could be a scenario where IWM screams higher and XRT screams higher. You'll lose $3 on your IWM, but ideally you'll make a lot more on your XRT.
Got it.
That's like the way I would structure a trade like this, where you're just sort of setting a premium neutral, but on the funding side, your risk, your cap, you're making sure that like your risk is capped.
That makes sense. The core position being then a bullish one, but specifically, geared towards sectors that look like they're strong, or at least have options kind of skew to them that favor buying the upside. Is that part of it, Danny?
And the whole scenario, right? In those scenarios, is also risk management. You always want to know where I don't ever really love selling naked calls, because obviously stocks could go much further than anyone expects. But this is like a way to risk manage a trade like this, where taking limited risk to fund unlimited risk, right? You're selling a call spread to fund unlimited upside in XRT. Not to say that XRT is going to double or anything like that. It's an ETF, but these things are somewhat correlated as well. And then one other thing that we've noticed is call spreads in general are very expensive. And I think that's because at the money options we think are rich, whereas out of the money are a little bit cheaper. So by selling a call spread, you're actually like taking advantage of this dynamic as well.
Okay, nice. That makes sense. So you kind of spread it, in a way that gives you that optimistic view, doesn't spend too much, buying premium, and timing. You think November still? Some of these things can come to fruition.
Yeah, I think no. I like November, because if we already see Polymarket's pricing in him losing this. So let's say next week, 2 weeks, you actually get a ruling, plus the government reopens, Christmas is back on, and you hear these refunds are coming. I think you do have some earnings too coming up relatively soon amongst some of the retailers as well, where maybe you get some near-term performance, and then if nothing happens, cool. If nothing happens either way, you didn't pay anything, right? You're not premium flat. You just do it again in December. You reset the strikes.
You mentioned Polymarket. I'm pulling up Kalshi right now.
That's what is this one?
This is
the mayor
Mamdani
election?
getting locked in.
Yeah, we don't.
So that's over and done with, right? Tell me what you think is relevant.
Oh man. Well, that's over.
While you think about that, Danny, hold on, because actually, when we're in Kalshi, that technically we're in our next block, which is this bad boy right here. It's the gamble, baby. All right, there we go. You like that, Danny?
Yeah, that is interesting.
Exactly. All right. What matters in the event contract space, do you think?
I mean, will tariffs be deemed illegal? I think it's 20%. That's like what we're keeping an eye on now.
Okay.
Or it's like, what's the ruling on the
Do they
tariffs?
reject the tariffs?
Yeah, that's kind of. I think that's the only thing I've been. I mean, we were looking at, obviously. I live in New York City, so the mayoral election was front and center. You're getting a lot of the REITs though actually rallying today that were selling off into it. So maybe it's a little bit by the news.
They're putting it. Kalshi says 30% chance, so
Yeah.
i.e. 70 against him. Do you think that's contributing to the market bounce? Do you think the market likes to see the possibility of tariffs getting some legal pushback?
No, I don't think it really matters. I think actually I
Yeah.
thought like I thought like anything that
The fact we came back since April, right? I mean, I think like nullifies
yeah.
the tariff argument. So the
Yeah,
tariffs
and I
have
also
been going
someone made
on.
the point where we've raised a few hundred billion in tariffs, and market cap of all stocks is up 14 trillion or something.
Yeah.
So I think the
So
wealth effect is a much bigger driver than anything. Then that's why I think tariffs have mattered as much.
completely,
Um,
entirely agree.
and
Go
today, as
ahead.
far as rallying, I think it's we sold off yesterday. The market's not allowed to sell off 2 days in a row anymore.
Right. Well, we'll see. I mean, the Bitcoin stuff looks pretty soft. That market looks cheap. I mean,
Yeah,
maybe not cheap, but cheap in name. That
yeah,
market looks weak, rather. So if that definitely went for more than 1 or 2 days. But stocks, just the chart technically has looked so much better, and I feel that there's now a whole other kind of bear case to argue in coins, which is all right. Like you got all the way to the president. Who's the next buyer? So I could see a world in which crypto softens up and it doesn't screw with stocks so much, but I generally still err on the side that it is helpful as an asset class to tell us kind of the sentiment of which way stocks could go, but I don't want to get too carried away with that.
yeah. I would say that as well. I'd say also that there's a lot of vested interest to make sure crypto doesn't go down too much. Some of
Yeah, that's true too.
So
Uh,
I think it's hard to on these dips. I think there's always someone out there who's ready to buy.
when will Bitcoin hit 150K? This is from Kalshi here still. Before June 2026, 43%. So, I mean, hey, people are thinking, maybe it's soured a little bit. The fact that it's only 43, I don't know. The
So
crypto,
that'd be up 50%.
what's that?
That'd be up 50%.
Yeah, effectively. Yeah, we're at 100K, right? So, yeah,
Yeah. So
before
so
June
what for what it's
2026.
worth? So for what it's worth, the IBIT 9100 call spread, if you wanted to do that, stock 60. So getting I guess you'd have to do like the 80-90 call spread, right? That'd be up 50%. You said
Okay.
June 2026.
Yeah, exactly. June 2026 is the Kalshi timeline.
Yeah. So the June 80-90 call spread in
Okay.
IBIT $60 roughly,
Yep,
right?
59
IBIT
bucks
or
right now.
so let's say up 50% is 90. That call spread's $1.73. So it's saying 17%, to make 10. It's saying the call spread is pricing a 17% chance. If you wanted like a super simple way to look at it.
Yeah. Okay.
I'm sure
All
there's
right.
some option geeks who would fight me on this way to think about it, but I don't really care. This is one way to look at it. A $10 wide call spread. Oh wait, it's a little more than that. I'm sorry. It's
Because
no, it's
if
less.
that were
So
the case, then Kalshi would be a little low, right? By like
right,
a few.
sorry. The June 80-90 call spread is $1.40. So
Okay.
it's saying
80,
you
90.
get yeah. So you may spend $1.40 to make $10. So it's like roughly 14% chance based on this. That's it's not completely apples to apples, but because this isn't binary, you'd have to expire over 90. But
Right.
roughly saying it's pricing in maybe a 15% chance based on
That's
just the
fair.
option market.
All right. I like that. I like that approach. So then maybe there's more optimism in the actual options market for Bitcoin than there is to some extent on the betting
Well,
markets,
yeah,
maybe.
perhaps.
Okay. Which is fair. I think maybe the betting markets might capture a more general audience where the actual crypto knights are, trading the asset. Maybe I don't know. There's always some kind of discrepancies though that do show up. When we're looking at the betting markets. Ethereum by the end of November, 30% chance it gets back above 4,200. That's kind of an interesting one. Oh, okay, now it actually looks like it's dropped. So above 4,200, 30% chance that Ethereum gets there. Pretty big drop that we had to 3,500. So that kind of seems a little bit more bullish in my mind that the market's pretty pretty rosy on ETH still, it seems like.
Yeah, I mean, through all this stuff, I'd rather just be long Robinhood.
Yeah, right? Pretty much.
Yeah, I mean that's what I think they have earnings tonight. Our analyst is bullish in the name. It seems like they have inroads into all of these pockets of the market, and thankfully we'll soon live in a world where you can parlay the Bulls winning the championship with Bitcoin being over 150,000. Could you imagine not living in that world?
We're getting closer by the day. That's
Thank
the sound
God.
of it behind me. Well, 143 for Hood, by the way. Interesting chart. It's kind of got like a triangle going on here where you still have the uptrend very much intact, but a lower high from the previous high. This was my chart, my stock of the year. So I'm glad that you bring that up. That's a good place for us to close and wrap. Danny, great stuff. Great range, sir. Looking forward to having you back. Appreciate you taking your time.
Yeah, thanks for having me. Congrats on the new seed. I love it.
Thank you. Yeah, it's fun. I like a lot of clicking. It keeps my attention, you know?
Right, good. Good.
All right, appreciate you, man. Great to catch
Thanks.
up, Danny Kirsch, head of options at Piper Sandler. Excellent work, as always. And I like the ending point on the chart as well there. The fact that Hood's kind of sitting right in that range is not a bad thing at all. Lower highs, but could be worse, could be worse. I'm going to look at the risk radar when we come back, go through a few of the most interesting things I see heading into tomorrow. Stick around. All right, welcome back here. Yesterday I went through a few updates to the risk radar. Definitely want to take another second look at that as the market firms up today. I don't think anything's really changed meaningfully from what I went through yesterday, but just kind of a reminder of where I'm at for that right now, because I do think it's worth pointing out. Yellow basically is kind of a theme right now. Stocks yellow, bonds yellow, dollar yellow. As I mentioned, bonds selling off and bringing the 10-year yield back above 4%, largely a positive development in my mind. You can zoom out on the 10-year chart, and a lot of it looks like a range that goes back 18 months plus. So I do think the yellow for bonds is pretty real. The dollar is very interesting. The dollar is at a point where it kind of looks like maybe it wants to make a move, like perhaps it could break out. The dollar chart is slightly off today, but had a really strong move over the last couple days. And it is important to realize that when the Fed started its original cutting regime, that was the low for yields. And the potential then for that to happen again, I think, does still linger to some extent. So if bonds do sell off, that generally helps kind of put a floor in the dollar. Right now, bonds haven't been doing too much. The dollar has had more movement. So given the dollar's upside here, I think you want to be aware potentially of maybe bearishness in bonds continuing like we see today, which I could argue also is a good thing, by the way. Dollar also rising in the context of tariffs. Remember that the dollar crashed really hard around the tariff onslaught in the spring. And that was a very interesting moment because you kind of have a thought where, all right, if tariffs are going to be so great for our country, then why wouldn't the dollar go up? So there is a very notable message that was sent by the dollar during the spring, which was that this stuff was going to kind of backfire on us. That also corresponded with the really strong outperformance of international stocks in Q1. So dollar could also be telling you maybe that the tariffs are going to get rejected, actually. If you go with the spring logic of dollar down being associated with tariffs getting put on, maybe the Supreme Court saying that the rumors, rather, the kind of momentum as we saw in Kalshi, odds being placed against the Supreme Court supporting the tariffs, i.e. saying that they're maybe unconstitutional to some degree, then maybe that's why the dollar is starting to firm up. So the dollar light is yellow, but it could go green pretty soon if the dollar continues to move. The other thing is Bitcoin on red. That's because the chart now goes back some distance in its bearish divergence, which is higher highs, but no higher highs on momentum. That's what I had warned about, not just this year, but in previous moments of Bitcoin running out of gas. That was the pattern that showed up technically on multiple occasions. So the fact that that is now broken below the 100 mark, bounced back, I think that was a pretty clear test of the sub 100 level. The fact that BTC firmed back up, I think that that has been generally encouraging. So maybe that's a good point to bring in Mr. Charles Moon, who is jumping on with us. Charlie, my guy, Prosper Trading Academy. How you doing, man?
I'm doing great, brother. How are you?
Well, make sure we got your audio here, because I know you just literally jumped on.
Mic check, mic check, mic
So
check.
we might have to double check that. But as I was saying, the BTC chart trying to firm up a little bit, 3% bounce, which is a $3,200 rally on the day, which is pretty solid. But otherwise, still kind of stuck after stocks generally made highs and higher highs. So make sure you're unmuted, Charles, and if not, we'll take a break and come back.
Can you hear me?
Give me 1 sec. We'll figure it out. Be right back. Charles. Test.
He left the Zoom meeting.
Oh, he might have restarted. All right, well, we're 3 minutes into I'll continue my spiel for a moment here. Okay, last point is I didn't actually even get to stocks. The stocks, I think, generally yellow while we're still kind of in this range. But I do think that if semiconductors firm up like they are today, this light quickly goes green again. Basically, the only reason why I had stocks yellow was because of the possible kind of crypto implications. Charlie, I'm going to try you again. What up?
Can you hear me?
Hey, there he is. I got some Charlie in there. All right, am I crazy for having stocks yellow on my radar because I'm worried about some of the crypto technical action, Charlie? Are the two not cut from the same cloth anymore?
Partly, yes. It was pretty crazy. The AI, the AI bubble popped yesterday, so to speak, and all of a sudden the Asian market started crashing. I believe the South Korean markets halted down. SoftBank was down, gap down huge. Nikkei was getting dragged, and all of a sudden it started ripping it to the upside. I think that things will firm up, and this is going with crypto as well. Once the government shutdown ends, I think that once we hit that historical mark, the markets really started freaking out, started going risk off. But this is why I believe that the shutdown ending is going to be a really bullish case, because now the FOMC is going to be fed the proper data. They can make that proper assessment in terms of monetary policy, which generally, again, we were last week at 90% probability of a December rate cut. We were, I think, 70% at a possible rate cut in January. So if we end up on that trajectory again, markets are going to be risk on, and we're going to go right back to what we're doing, which is the grinding up.
Yeah. Okay, I like that. So you think cuts are still playing a major role here? More support from the Fed coming on the way?
100%. And, I think the thing that really kind of stands out to me was the fact that they ended QT. So they're stopping the unwinding of balance sheets. So the next question is, when do they start quantitative easing again?
Well, I know a lot of folks have been expecting that for a little bit, but they haven't had to go that far yet. I remember we were hearing predictions of that happening already at this point this year, so I'm kind of glad it hasn't gone it. I'm a little worried what would make us, if we were there, I don't know if I'd be cheering for anything. That's kind of like the point earlier I was saying with some of the analysts cheering on sub 4% yield. I don't think we want that. I think we want like stable bonds. I think we want general economic strength. I hope we don't have to start doing some QE redux.
I like the idea of stability. We haven't really seen stability, quite honestly, all year. We've seen pockets of it, but, once we get to the point where things are really nice and comfortable, we'll just get back to doing what we're doing. But, the instability right now, especially being at peak value, it's causing some mayhem. Look at the performance of the Mag 7 stocks right now. This does not look like a healthy market yet. We keep pushing towards all-time highs. I think really the Fed is going to be that final decisive factor where we could just get that firming and really consistent move, without major concerns about the overall markets, about bubbles, and more importantly, about our economy.
Well said. I'm looking at MAGs right now, the Round Hill ETF, of course, and I mean, it looks pretty darn good. It looks like it had a breakout, it gapped up, and then it held, What's not to like about the technicals, right? It's maybe it's bubbly, maybe it's valuation-licious, bubblicious. I don't know. I feel like it's still generally these companies are just. I keep referencing this show itself. It's literally there's a good bit of AI behind this thing.
And obviously that's the charging force here. It's all about NVIDIA now. It used to be about Amazon. It used to be about Apple. But, we've seen how weak Microsoft has been. Meta's below their 200-day moving average along with Netflix. We've seen AVGO charge up in terms of market weight. We've seen Palantir charge up in market weight. So, right now the base case for the most powerful companies in the world, they're not as powerful as the markets are starting to price in the future. And clearly the future is the belief is in AI and anything around it.
Yeah, that's kind of where I keep falling back on as well, which is that there is a very real productivity boom happening because of this. There is a very real economic impact. I was talking yesterday about that chart that shows the S&P 500 next to job openings and ChatGPT, and then job openings drop, and then the chart for S&P keeps going, and everybody was like, how could this be? And I'm like, isn't that like the definition of productivity? Isn't that what makes the capitalist wheel turn?
Right. And, honestly, we almost forget that the Mag 7 is the driving force of the markets. And the truth be told, it's really the sprinkle down effect from companies like Google, Amazon, Meta with their CapEx spending, Microsoft as well, which trickles into NVIDIA, which is obviously trickling into everything else. So, even though the performance of these stocks aren't as strong as NVIDIA, as Palantir in terms of, year-to-date performance, the truth of the matter is they're the reason why this market remains propped up due to their CapEx spending. Yeah,
that's true. That's the fact, right? Is that you really have a real force, an economic force that's coming from this tech. So until that stuff breaks down, which it hasn't, it's hard for me to sweat it too much, Charles, until I really see the SMH get blasted. It just, to me, that is really the default. You know, that's kind of the way that we should generally be watching this market. And it worked pretty well for me the last couple of weeks because some of the crypto stuff started breaking down. And people were getting all hyped up about some of the political stuff. And I was just like, look, SMH looks like it's in an ascending triangle. And guess what? It did. It broke out and it ripped. So I think we're on the same page, basically. You know, it sounds like somewhat of there's all these things going on around the periphery, but at the end of the day, sometimes simple is the smartest, and watching this group is oftentimes the best to tell.
Yes, sir.
Yeah. Charles, bell just rang. You the man, glad we got you. Thank you as always, the Prosper Trading team. Excellent. Good take, Charlie. Appreciate it, man. Thanks a lot.
Thank you.
You got it, Charles Boone. Prosper Trading Academy. That is it. Bell rang, which means it's time to go. Thanks for
guys.
tuning in. That was fun. I think we're getting a little better. I'm liking hitting the buttons. So I will see you guys tomorrow, 2 p.m. to 3 p.m. again. Have a great night.